I just want to get his take on the markets, treasuries, the economy amid this government shutdown. I want to bring in Drew Matus. He's the chief market strategist at MetLife Investment Management. We keep moving higher. Are we moving too high, or you can only get higher if you go higher? So where are we?
Well, I think that's a great point. When you compare what earnings expectations are and you compare it to growth expectations among economists, there's a gap there. And if you're not going to get the nominal growth, where exactly are you going to get the earnings expansion from? And then if you take another look at it and you say, okay, well, why is the market behaving the way it is? What is it betting on? It's obviously betting on an AI story, but it's not necessarily betting on the AI story. It's betting on the AI investment story. And the key part of the AI component will actually be what it does to productivity going forward, and then what it does to potential growth in the long term, rather than kind of some sort of a short-term expense dynamic that I think is currently being bet on.
So if we had this conversation a year from now, where would the market be?
I think the market's going to have trouble kind of continuing its ongoing increases. I think you're looking at kind of, where we are today, plus or minus 10%. I actually think 2026 is going to be kind of a stall year. I think yields are going to stay sticky. Fed's going to be cutting interest rates. You're going to see a steepening of the yield curve. And you're not necessarily going to see a lot of forward momentum in equities over the next year.
Are you a believer that this AI boom is real? I mean, it is real. The question is it going to pop to some degree?
I don't know about pop, but I do think this. I think that, when people talk about AI and we talk about the potential for AI, and I'm a big believer in the potential of it, the question really is, what are companies going to do with it, right? It's not a matter of, oh, we're going to build this to support the AI initiative. Oh, we're going to do this to support AI. Supporting AI in and of itself is not the goal, right? It's what AI can do and how AI can reimagine companies and how companies can reimagine processes using AI, and how much more productive American workers can be with AI, how much better students can be with AI tutors helping them learn things in school. And I think when you look at the long-term bet on AI, that's kind of a productivity enhancing U.S. growth potential, basically solves the budget deficit story. You can solve a lot of things with AI improvements, including workforce declines and the like, with improvements in labor quality and higher levels of productivity leading to higher potential growth.
Given that we're on a Jobs Friday without jobs numbers, though, if all of that is right, you might have a productivity boom, you might have a jobs problem, in which case you could have an economic problem.
Well, yes, and we're seeing some worrying hints of that, right? I mean, I think youth unemployment as a ratio of total unemployment took another step higher over the last couple of years. And the last time it took a step higher, like the one we're seeing, was when computers started to become widely used and you got rid of clerks. And so there are these problems we're going to have to address, but at the same point, let's look a little glass half full. Even though I am an economist and work in fixed income, you have the potential to dramatically improve labor quality in the United States through better educational outcomes, and it's hard for me to see how that's going to be a downside. I will tell you, I had an intern this summer, and the things he was able to do and the way he thought about things was extraordinarily different than the way I think about things. And he was much more effective at using the tools that are going to be in place by the time he graduates from college. And I tell you what, if no one hires him, he'll go and do his own thing, and we'll be talking about him on your program in 5 years and wondering, what country he's planning on buying.
Drew, let me ask you one other question, talking about fixed income and the bond market. There's been a lot of people who've said for the last 6 months that given all the questions about the independence of the Fed and the Lisa Cook situation, which I know has been sort of resolved, not resolved, I don't know what you think of the Supreme Court decision and everything else, that the bond market was going to react badly to all of this, that all of the sort of different things coming out of a chaotic Washington would ultimately be bad for the bond market, and maybe to some degree they are, but you have not seen this hair on fire moment. Why?
Yes. Well, I mean, in order for there to be some sort of question about Fed independence, you have to basically say that Governor Waller and Governor Bowman are just going to kind of do exactly what they're told. And I think, anyone who's listened to their talk, anyone who's listened to how their views have evolved, it's a natural evolution. It's not an abrupt evolution that seems like it's coming from the outside. And so, I don't think you can say just because Governor Waller happens to agree with President Trump on something that he's compromised. And I think, people are rushing to conclusions and suggesting perhaps that the Fed is too fragile of an institution. I think the Fed is much a stronger institution than people give it credit for. And we should really just, and so I think, the market finally got wind of that and realized that they're overreacting. And with regard to the budget deficit, the simple fact of the matter is the budget deficit's a problem, but no one seems to care. And you can't force people to care if they don't want to care. And that's frustrating to people who look out and see a problem. But the reality of it is that you can talk about it. And when you start talking about it, people's eyes glaze over and they want to talk about something different.